Hello, everyone, and welcome back to Gold Off the Charts, where we bring you sharp financial insights every day to help you cut through the noise and understand the true nature of wealth. Let me start today with a question. When you check the charts and see gold hovering around $4,500, like a tired giant catching its breath, does your eye get caught by that wild number right next to it? $75. That's right, silver. For years, silver was called the poor man's gold, ignored and criticized for being too volatile. But look at it now. Like a beast breaking its chains, silver just smashed through the $75 mark. We are witnessing a historic moment, a massive divergence between gold and silver. Gold, the big brother, has decided to set up camp and rest at the $4,500 level after a non-stop rally throughout 2025. But silver, the little brother, has no intention of slowing down. Instead of following gold's lead and pulling back, it's launching into an even steeper, more aggressive climb. This has everyone, including top Wall Street traders, asking the same thing. Is silver going to be the main character of the 2026 precious metals bull market? If an analyst told you that $75 is just the beginning and silver could soar to $200, would you think they were crazy? Don't be too quick to judge. Because today, I'm showing you a historic shift happening in the London markets. This isn't just hype, it's an active bank run on physical silver. We are at a turning point involving an epic short squeeze that could define your wealth in 2026. So today, I'm taking you deep into the mechanics of the silver market. We'll look at the negative interest rate indicator that's terrifying the bears and discuss economist Jim Rickards' shocking prediction you don't want to get left behind in this storm. If you want to understand the massive wealth opportunities hidden here, make sure to watch until the end, because this could set the ceiling for your gains in 2026. Let's skip the small talk and get right to it. Why is silver exploding? Is it because people are buying jewelry for the holidays? Definitely not. The real driver is in London, the world's capital for physical precious metals trading. According to the latest data, London is facing a grim, epic physical squeeze, which simply means investors no longer want paper contracts. Everyone wants the real thing in their hands. In the past, institutions were happy with paper silver futures contracts and digital bank balances. Everyone assumed the vaults were full of silver bars, but that trust has evaporated and investors are dumping paper to scramble for physical bullion. This panic has caused a massive distortion in a key metric, the one-year silver swap spread, which has hit a staggering negative 7.18%. If that sounds like jargon, let me translate it into plain English. Normally, silver for future delivery is more expensive than silver today. That's because you have to pay for storage and insurance over time. This is known as a carrying cost or positive market. But right now, the spread is negative 7.18%, meaning silver today is much more expensive than silver a year from now. The market is essentially saying, I need silver right now and I'll pay a premium to hold it. I don't care about silver a year from now. This is an extreme spot premium. Experts say this distortion is the real engine behind the price hike. It proves that physical silver is becoming incredibly scarce. The London vaults are likely being emptied, leaving banks and market makers, the shorts, who only hold paper and no actual metal in a disaster scenario. They are like ants in a frying pan, under massive pressure because if customers demand physical delivery and the vaults are empty, the banks have to buy it from the market at any price. That is a short squeeze. This rally isn't a bubble. It's a correction caused by a total collapse in supply. As long as that negative 7.18% spread exists, the fire is still burning. As long as the scramble for physical metal continues, silver will be hard to stop, and while London shows us the current shortage, Wall Street is predicting future madness. Jim Rickards, the famous economist and author of Currency Wars, recently dropped a bombshell prediction in an interview. He stated, the forces driving metals will only get stronger next year. I wouldn't be surprised to see gold at $10,000 and silver at $200. Does $200 sound like a pipe dream? It's at $75 now, so that's nearly a triple from here, but let's look at the basis behind his call. It's actually quite grounded. First, there's the debt black hole, the US. National debt is spiraling, and interest costs are astronomical, leaving the Fed with no choice but to print more money. This will eventually destroy the dollar's purchasing power, and when the dollar fails, silver priced in those dollars will naturally skyrocket. Second, geopolitical tensions are rising, and the world is fragmenting. In times of war and uncertainty, people lose faith in digital credits and turn to physical assets. Also, consider inflation. Silver's all-time high in 1980 was $50. In today's money, that is actually well over $200. So, looking at purchasing power parity, silver hitting $200 is really just it returning to its former glory. Rickards believes we aren't just seeing a supply issue, but a crisis of faith in the entire fiat currency system. He highlighted a terrifying point. The ratio of paper contracts to physical inventory is roughly 1:0:0 to 1. That means 100 people hold paper receipts thinking they own silver, but there is only one physical bar in the vault. If even 2 of those 100 people demand their physical metal at the same time, the whole game collapses, and that is why he sees $75 as the floor price. To summarize Rickards' view, this isn't a short-term trend. It's a currency reset, and it will only accelerate in 2026. When silver holds above $75, it's not the peak, it's likely just the first base of a massive bull run. However, while the opportunity is huge, the risks are just as intense. As I mentioned before, year-end liquidity is low, and silver is naturally more volatile than gold. With this short squeeze, price swings will be magnified. Expect the silver chart to look like a racing heartbeat. It could jump 10% one day and drop 8% the next. If you're trading with high leverage, these swings will wipe you out in seconds, so you have to be mentally prepared for a roller coaster ride. Don't panic sell during a dip, and don't go all in during a spike. Staying calm and keeping leverage low is the only way to survive until we hit $200. Finally, let's check back in on gold. Some are asking, silver is flying, so why is gold stuck at $4,500? Is it over? I think it's the opposite. Gold's behavior is actually very healthy. Staying steady at $4,500 is a necessary deep breath after a massive 70% gain this year. Remember, a 70% jump for a multi-trillion-dollar asset is incredible. It's natural for big institutions to take some profits at the end of the year, which creates selling pressure and keeps the price capped for now. But notice that despite the selling, gold hasn't crashed. It's holding $4,500 firmly, which shows there is huge demand waiting to buy every dip. We call this refueling in midair. The market is shaking out the weak hands and building strength for a fresh breakout in 2026. Gold's status as a safe haven is a global consensus. That hasn't changed. Once the holidays end and the money starts flowing back in, gold will wake up. It's likely just crouching so it can jump higher, so don't let this brief pause discourage you. To wrap up, silver is undergoing a fundamental shift. The London physical run and that negative 7.18% spread are the real deal, supporting a move toward $200. This short squeeze drama is just getting started, but watch out for that year-end volatility. Buckle up and manage your risk. Gold is simply consolidating. The $4,500 level is a healthy base for the next leg up in 2026. The bull market for precious metals is here, and while this could be a once-in-a-lifetime wealth transfer, it's a game of patience and discipline. As always, this is my personal observation and not financial advice. Your wallet is your responsibility, so do your own research. If you found this helpful, please like the video, subscribe to Gold Off the Charts, and hit the bell icon to help the algorithm reach more people. This is Gold Off the Charts. Thanks for watching, and I'll see you in the next one. Bye!